You're listening to the Sound Money podcast of my show, covering the spread on 91.5 WNYE New York. For more news and headlines, as well as our latest interviews, you can visit our website at coveringdelta.com. Joining us now is Peter Schiff, CEO and Chief Global Strategist of Euro Pacific Capital and author of the Little Book of Bull Moves, Updated and Expanded. Peter, one of the things that we hear often from economists like Paul Krugman is that during a recession, the government, in conjunction with central banks, must step in to fill the gap in demand caused by consumers looking to cut back consumption and increase savings by virtue of deficit spending and money printing. Can you explain to our audience how this policy distorts market signals essential to any self-sustaining recovery, specifically delving into, if you can, the essential role that interest rates play in enabling the proper allocation of capital from savers to investors?
Well, sure. In a recession, the recession is actually the cure for the disease. The disease is the artificial boom that results from a government that is too easy with respect to monetary policy. You have artificially low interest rates that are not brought about by genuine savings, but by Fed manipulation, and it causes businessmen to make decisions that, absent those false signals, they wouldn't make, and it results in a very bad misallocation of capital. And what happens is when you finally get the bust and you get the recession, the market is trying to solve the problems and restructure the economy on a more solid foundation. And so when you have a recession and consumers are increasing their savings and reducing their spending, that's exactly what they need to do. And if the government tries to interfere with that process by just going into debt and spending money, then it's preventing the economy from restructuring in such a way as to create a lasting recovery. And all you end up doing is exacerbating the problems. And people like Paul Krugman, unfortunately, even though they have a Nobel Prize, really don't understand basic economics. And if we continue to follow their prescriptions, it's going to lead to economic ruin.
So why does it make sense then for a central authority like the Federal Reserve to set interest rates, which is essentially the cost of capital or the price of money, but not to set, let's say, the price of bread or the price of gas? And if the market can set the interest rate more efficiently than any central bank, what exactly is the purpose of even having a Fed?
Well, you're right. I mean, the Fed should not be setting interest rates. It's price fixing. The Fed has no idea what the proper interest rate should be, or any more idea than it has what the price of bread should be, or the price of a computer. You need to have prices, including interest rates, which are the price of borrowing money. That needs to be set in a market. And obviously, if the free market were setting interest rates in the United States and not the Fed, rates would be significantly higher than they are right now. So the question is, what damage is being done to the U.S. economy because interest rates are so low? Just remember, the housing bubble and the ensuing financial crisis, that was caused by the low interest rates of the Federal Reserve. The economic stimulus in 2001, 2002, that's why we had a housing bubble. Interest rates were too low, that and government-guaranteed mortgages. But look at all the damage that the government did, that the Fed did to our economy with those low interest rates. And imagine how much more damage is being done to the economy now, where rates are even lower, where monetary policy is even more reckless under Bernanke than it was under Greenspan.
So going on that, one of the biggest questions hanging over the markets today is whether or not the Federal Reserve is finished with its major money printing operations. Do you believe that once QE2 is officially completed, that Bernanke will wait for a market correction before resorting to QE3 or QE4 or whatever? Or should we expect the monetization of debt to just continue unabated?
I think it will continue unabated. I think Bernanke knows that if the Fed pulls back, the bond market will implode, interest rates will rise sharply, and this whole phony economy will come collapsing down. So he might pretend that QE3 is over, but he will continue to be a major buyer of U.S. Treasuries. They will continue to expand the size of their balance sheet, and the way they do that is they're printing money. Because if they don't do that, if the Fed stops buying, who is going to buy Treasuries at these low yields? Nobody. And yields will have to rise sharply in order to convince individuals to put their own money into 10-year, 20-year, 30-year Treasuries. They're not going to do it for 3.5%, 4%. They're going to need much higher interest rates, but our economy can't survive high interest rates. The only reason that it appears to be growing is because rates are so low and we can spend borrowed money. And, of course, the only reason the government can handle a $1.5 trillion budget deficit on top of a $14, $15 trillion national debt is because it's got a teaser rate. But if the Fed takes that teaser rate away,
and the U.S. government is looking at, a more realistic rate on its debt, it can't afford it. And so it's either going to have to default, restructure, or, impose massive cuts in Social Security and Medicare, and those are things that the government just seems unwilling to do.
Well, how much longer do you think the Fed can continue to push down long-term rates? Because we're told, of course, that the Fed can only control the short end of the curve, but as you know, QE has been all about trying to push down the long end. And in fact, the Fed may be using Treasury puts, issuing an artificial number of Treasury puts to try to keep expectations of the long end down. And what effect, if you heard about that, what effect do you think that would have?
I don't know. I mean, I know that they can be effective for a while by manipulating the market, and that's what they're doing, and they're buying bonds by printing money. But the consequence of that is that the dollar loses value, not only against other fiat currencies, the dollar hitting new lows today against a number of currencies, but more importantly, the dollar is losing purchasing power in terms of real things. You have gold and silver prices rising sharply. You have the price of oil, all the price of food. I just watched a report on CBS News this evening about skyrocketing coffee prices. Of course, no mention of why they're skyrocketing. I mean, they talk about speculators or demand in India, but that's not why coffee prices are rising. They're rising because of quantitative easing, because the Fed is creating inflation. They're printing money. That's why the price of everything is rising, and that is the consequence of what we're doing. And eventually, there will be no buyers. The Fed will be the only buyer of treasuries. Right now, they're about 70%. Eventually, they're going to be the only buyer. And then it's not just treasuries. They're going to have to buy the munis. They're going to have to buy the corporates. They're going to have to buy any dollar-denominated debt because nobody will buy it at these low rates of interest when inflation is substantially higher than rates.
Keeping with that, can you touch on how when the Fed pushes down the benchmark or the lowest risk rate in the economy, how that influences, from a micro perspective, investors to push for better yield elsewhere, which pushes yields down across the board and causes massive risk-taking and potentially other credit bubbles in the economy?
Well, certainly, but once there is a perception that even that even a 5 or 7 or 10% yield is not sufficient to restore your lost purchasing power during the holding period, investors are going to shun a higher yielding debt just the way they shun treasuries. During the credit bubble in the 2000s, you didn't have this fear of inflation, so people were willing to assume a lot of risk for a relatively low rate of return, like they did in the mortgage market. I don't think that's going to happen this time around. As investors begin to correctly perceive the inflation risk and the risks to their purchasing power, they are not going to lend money at low rates. They're going to need very, very high rates, and the only way the Federal Reserve is going to stop rates from rising across the spectrum is if it just expands its QE and incorporates more types of debt into its purchases. But that only means it creates even more inflation, which makes dollar-denominated debt that much less attractive. And it sends prices up at an even faster rate. And we get into this inflationary death spiral, and unfortunately, that's where we're headed.
Well, do you think that we can get that kind of inflationary death spiral in the short term just with the increase in the adjusted monetary base without, let's say, banks and the fractional reserve lending that goes with it? Would we be able to see a type of hyperinflation? I mean, how would you see that occurring?
The money is being created and spent into circulation by the U.S. government, and you have tremendous numbers of dollars already in existence and circulation being held all around the world. Eventually, they're not going to want those dollars anymore. They're going to look to liquidate them, to spend them on whatever they can, and you're just going to see a free fall. We could start to see a free fall in the dollar maybe as early as the fall. I mean, the technicals are really breaking down. And, you do have a lot of people that, perceive some of the problems that we have in our economy, but they jump to the wrong conclusion that the risk is deflation, not inflation, and they don't understand, a lot of people, when they think about deflation, they think, that's falling prices. Well, deflation is a contraction of the money supply.
Sure.
Inflation is an expansion. Money supply is not going to contract. It's not contracting. It is expanding, and prices are rising. But, if you want to look at prices, view prices through the prism of real money, which is gold and silver, yes, there you see deflation in a sense that the price of everything is falling. I mean, even the price of gasoline, which everybody says is rising to a record high, in terms of real money, it's actually falling to a record low. So you are getting this deflationary decline in assets and goods if you price them in gold and silver. But, of course, if you price something in U.S. dollars, the price keeps going up because the dollar is losing value faster than the stuff that you're buying with it. And that's what's going to happen. In every country that has gone into a major economic collapse for the reasons that the U.S. is headed for one, it's always been with runaway inflation. I mean, that's what happens when you have fiat money in the printing press. That's why the founding fathers of our country forbade the federal government from issuing paper money. That's why they put us on a gold standard, because they understood the dangers of paper money, because they understood history. Unfortunately, modern American politicians and economists are clueless about history.
Yeah, so people don't actually know that it was punishable by death, counterfeiting.
And you know what counterfeiting was, though? Counterfeiting was taking coins, gold and silver coins, and making them without putting all the gold and silver in there that was supposed to be there. It was you were creating money of less value than was legally required. Whereas today, counterfeiters are not counterfeiting anything, because our money has no intrinsic value to begin with, so it's impossible to counterfeit. It's already counterfeit.
At the end, I want to touch on that again, because I know you spoke about the founder of the Liberty Dollar. I think he was prosecuted for counterfeiting, and I want to get to that. But speaking about gold and precious metals, you've been a huge gold bull since the start of the bull market in the early 2000s at least. What do you say to those like Nouriel Roubini who claim that gold and other precious metals are in a bubble?
Well, they're wrong. I mean, Nouriel Roubini only understood a small part of the puzzle. You know, I used to hear and read Roubini's stuff back in 2005 and 2006, and he understood the housing bubble, and that's about the only thing he understood, and that's about the only thing he got right. But as far as all the rest of the macro, he got it all wrong. And, you know, if you've been following Nouriel Roubini's investment advice, you haven't done very well, because he doesn't understand the real dynamics at play. And that's why he thinks that gold and silver are overvalued, because he doesn't understand what's happening. In fact, they're not overvalued, they're still undervalued. And the fact that so many people think gold and silver are undervalued is one of the things that's fueling the bull market. It's creating the wall of worry where the markets are climbing. And eventually people will, like Roubini, will figure it out. But by then it'll be too late.
Tell me something. Why is the claim that there is not enough gold in the world for it to function as reserve currency a nonsensical argument? Can you explain that to our listeners?
I mean, first of all, the idea is money needs to be scarce. I mean, that's what gives it value. You don't want it to be abundant. It has to be something that's rare. But the actual quantity of the gold doesn't matter, because prices will adjust. So if you have a small quantity of gold, then the price structure will be lower to accommodate that. But that's fine. You know, it doesn't matter. You can run the world economy on 1 ounce of gold. If prices would just be very, very low, but it would still function. And people think, well, we can't have falling prices. Well, sure we can. I mean, falling prices are fine. You know, we had falling prices throughout the entire Industrial Revolution. In fact, for the first 120 years of our country, we had falling prices almost every year. And that was because we had sound money. And, so the people that have arguments against the gold standard, what they really want to do is empower government, because gold takes away the power of the government to run deficits, to create the illusion of the free lunch, where it gives people something for nothing. Gold is like the chaperone, at a high school prom. The students don't want the chaperone, right? The politicians don't want gold chaperoning their activities, but the public should. The people should. We need to discipline our leaders, because absent discipline, you see what they're going to do. I mean, they're destroying the country. And if you look at how our country did under a gold standard, if you look at how the economy grew, it performed much better during a period of gold standard than under a fiat standard. So these arguments are just nonsense.